Good afternoon to you all budding entrepreneurs. Thanks so much for joining us today. My name is Caroline Player, and on behalf of the Georgia Tech Alumni Association, I welcome you all. We are in for another treat today as alumna entrepreneur Lara Hodgson guides us, also bringing in a special guest that we'll hear more about later. Let me tell you a little bit about Lara. Lara is president and CEO of Now Account, and she's launched product and service businesses, raised capital, and served in executive management roles with Nourish, a patented consumer product for children, Insomnia Consulting, an infrastructure development company, Dewberry Capital Corporation, a $400 million private equity firm in which she was founding principal, Dunk, a performance footwear and apparel brand, and IXL, an internet development company. Lara has extensive experience in brand development, corporate strategy, business development, marketing, and operations, and she's worked with companies such as Nike, Coca-Cola, the Home Depot, Keds, and others. Lara received an MBA from Harvard Business School and a bachelor's in aerospace engineering with highest honors from Georgia Tech, where she was a scholarship member of the varsity track team, was named one of the top 20 students in the U.S. by USA Today, and was selected to study in Japan with the U.S. Department of Defense. Lara has also served as the ambassador to Lebanon during the 1996 Olympic Games. Lara is a member of the Leadership Atlanta class of 2004 and Leadership Georgia class of 2005. She was honored by the Georgia Tech Athletic Association with the Total Person Alumnus Award and by the Georgia Tech Women in Engineering organization as Alumna of the Year. Lara is a member of the Georgia Tech Young Alumnus Hall of Fame and is internationally recognized speaker on innovation and creativity. She's also an adjunct instructor at Scheller College of Business. So Lara, let me turn this conversation on capital over to you.
Great. Well, thank you, Caroline. And for those of you that have been on our calls before, you know that when Caroline does that big, long introduction, it just makes me realize that as my business partner and I say, I probably have unmedicated ADD, which is what most entrepreneurs probably have as well. But as Caroline mentioned, you know, we started this as sort of a series to touch on a number of different topics that are important to whether you're an entrepreneur starting a business, whether you are running a small business, whether you've inherited a small business. Some of us actually start businesses that we don't realize we're starting at the time, and your hobby becomes a business. So what I thought I would do is just kind of go through a little bit of the contextual background of how we got to our topic today on capital. And then, as Caroline mentioned, I have a fantastic guest with us today. John Hayes is also a Georgia Tech alum and has a much longer list of accomplishments than I do. And I'm proud to say he's also my business partner. So John is going to participate and kind of walk us through some of the really innovative ways that he has thought about the different types of capital that can help businesses grow depending on the stage of growth that they're in or the type of business that they are. And in fact, John has published a book that looks at balance sheets and business financials in a very different light. And I think what you'll find is it may be the first way of thinking about financials that makes sense to any engineer. If you're like me, when I went from engineering school to my MBA, none of that stuff made any sense until John showed me a graphical way to think about it, and then it all made sense again. So you're in for a treat today, and I think you'll find that this is not the normal capital conversation that you've probably heard time and again at conferences. So we'll get started, and like I mentioned, some of you may have been on some of these webinars before, and I kind of set them up all the same way, and then we'll dive more into the capital. But I always start kind of talking about what do you want your business to do? And I always ask the question, do you want your business to grow? And people think that might be sort of a strange question because the answer is probably yes for everybody, but that's really not true. Not everybody wants their business to grow. Some people start a business. It might be a consulting company that's just yourself or yourself and one or two other people, and you've built that to a level that it generates the income that you want on an annual basis, and you're happy with that, and you have the lifestyle that you enjoy, and that'll continue until you decide to stop. So I often ask, are you starting a business or are you starting a job? because a lot of people start businesses to create a job for themselves, and that's fantastic. But if you have a business that is growing beyond you, and it is more than a job, and as it grows, it needs more resources, it's got opportunities that are larger and larger and larger, that's really where you have to start to think a little bit more strategically about the type of capital that you're using to fund your business. So that's always the question I start with, so that you have the right mindset. Are you trying to grow your business, or are you trying to maintain the business that you already have? And so as we started this series back in February, we talked about the 4 things that a business needs to grow. We talked about customers, and that was the topic of our conversation in February, talking about all of the different ways to think about reaching new customers and growing the depth of your customers. We talked about capacity, which was our topic last month in March, and thinking about how to grow capacity in a way that's healthy for the business, as opposed to capacity growing you, which in some cases is the beginning of the end. And today, of course, our topic is capital, which seems to be every small business's favorite topic, because none of us seem to have it. So we always want what we don't have. So that's what we're going to focus on today. And then, of course, next month, we'll get to the topic of commitment. And from there, we've got a whole series of events, many of which will bring in other Georgia Tech alums to share their stories as well. So today, our focus is capital. And, you know, as I thought about that, I think some of the things to keep in mind, and this will all make more sense when we get into some of John's models, is people are often out there looking for money, but they think all money is equal. And I think it's important to note that someone could hand you $1 in 3 different formats, and that dollar is not equal to the other dollars. I know that makes no sense to an engineer, because $1 should equal $1. But in fact, $1 of equity versus $1 of debt versus $1 that was the accounts receivable that you had, or $1 grant, are all very different in terms of their cost. They're different in terms of their cost of capital, they're different in terms of their risk, the cost of risk, and they're different in terms of the cost for you to administer, monitor, and optimize the value of that capital. So I know it's hard to break an engineer's mindset, but 1 does not equal 1 does not equal 1 in this equation. The second thing is, if all dollars are not equal, you have to think about using the right dollar at the right time for the right use. And if we get that wrong, unfortunately, your business may in fact become a hobby, which means it doesn't make any money and it's not sustainable. And so you'll see this theme as we go through these different models and ways of thinking about it, that there is no one silver bullet. There is no one perfect dollar out there. And so you really do have to think about, am I using the right type of dollar at the right time in the stage of my business's evolution for the right use? And we'll talk about different examples of that. And I always go back to, you know, my favorite definition of an entrepreneur is a person who pursues a goal without regard for the resources currently under their control. So that would suggest that all of us are lacking something. We're lacking capital, we're lacking resources, and so we have to find those resources somewhere. They're not in our own pockets in the back of our pants, and so we have to find them somewhere. And again, the source that we're getting it from matters, and it matters in terms of your success or lack thereof. So as we think about that, those that have been on the calls before with me know that I feel very strongly that we talk a lot about startups when we're talking about entrepreneurs. And the startup of a business is actually relatively easy. In fact, you know, we live in a world today where it's never been easier to start a business. And I mean that in terms of having an idea, being able to mobilize resources, being able to get, you know, prototypes out there, get your idea to market. That's probably never been easier than it is today. It's the next step that's the hard part, which is then being able to scale that meeting. And so at the end of the day, when you're starting your business, your mindset is probably focused on minimizing your capital output, proving the market demand for your product, and making sure that most of your cost is variable, because obviously fixed cost in an early stage world of unknowns is very risky. So the key when you're in that startup phase is really flexibility. Making sure from a capital perspective that you don't put in place fixed payments and deadlines that may or may not match with when capital is flowing into your business, right? So having a deadline where you know there's a certain day that you owe somebody dollars is scary because you don't know when your dollars are coming in. Your customers might pay on any number of different schedules. So making sure that you're able to match that capital inflow with your capital outflow. And so today we're really going to focus on sort of that scaling up phase, which, you know, again, if you're trying to grow your business, your goal is to get to the scale up phase, not to live forever in the startup phase. And as you get into that scale up phase, capital is usually the largest limiting factor to growth. If you ask any business owner, what is the one thing that keeps you from growing, it's almost always going to be capital. The timing of that capital is key. And, you know, believe me, having lived in and around, you know, the world of MBAs and business schools, there are people who, you know, think that the solution to every problem is to go out and raise a huge amount of angel investment or venture capital and put all this capital in your business and grow. That works for some, but it really doesn't necessarily work for everyone. And I think John and I will both share examples where that's probably not the ideal model if you're trying to build, you know, a sizable amount of value for you and your shareholders. Certainly giving away your business is probably not the way to do that. As you're scaling up, you'll find that a lot of the variable costs that you set up shift to fixed costs. And that happens because as you're scaling and you're building infrastructure, a lot of those variable costs, like it or not, become fixed. And so the slide that I had before where we talked about keeping it variable and making sure that the timing of your inflow matched your outflow may in fact not be possible when you get to that scale-up phase. So again, you have to think about the type of capital that you're bringing in and whether it matches the cadence of your business. And so you will have to expand the types of capital that you have. And we'll talk about, you know, what that range is. And at the end of the day, when you get into scale-up, you'll be in an ongoing debate with yourself over the importance of cash flow versus profitability. You know, time and again, you run into businesses that say, well, my product is profitable. But if you have no cash flow, you'll never live to see the profitability. And so thinking about not only the fact that you can make money on each unit of good or service that you sell, but the timing of when that money actually shows up in your bank account, which is really the only place that it can be in order for you to use it. So at the end of the day, as I mentioned earlier, all dollars are not equal. I often say that, you know, if someone came in and said, I'm going to invest $1 in your business, and another person walked up to me and said, I'm going to loan you $1, and then a third person came up and said, you know, here's this $1 that just came out of your own operation, those all have very different forward costs in terms of the actual cost of the capital, the interest that you have to pay on it, in terms of the cost of the risk, meaning that if you don't pay that back or make the return, what does that do to your business, and then the cost to administer that capital. And so as I think through sort of my experiences getting to where I am today, you know, I started out working in very fast-growing companies, all of which were backed by large amounts of venture capital and private equity. And so I started out back in what I call the web crazy days with IXL. You know, we started out, we raised a large amount of capital from different venture capital firms. We essentially did a huge roll-up where we acquired 46 companies over the course of a couple of years, scaled exceptionally quickly, got out into the global marketplace where we had, you know, offices in almost every country, it seemed like. And so that was one model, but we also were very much riding the capital markets. And so I can tell you with a great deal of cringing that, you know, when the market crashed back in 2001, we all felt that because we had brought in such huge amounts of capital from those sources. From there, I ended up going and starting a company called Dunk, as Caroline had mentioned. It was an athletic footwear product designed with Shaquille O'Neal and others. And again, we were venture-backed. And so we had brought in huge amounts of capital up front. We had made huge investments in infrastructure up front, building a manufacturing facility in Macau, doing just-in-time manufacturing. And so, you know, I saw what it felt like to bring in huge amounts of third-party equity dollars very early in the business and realized the risk that brought into the model. And so from there, when I started my first company, it really was, you know, I'm not sure whether it was a business or a job. In a lot of ways, it was a job because it was a consulting company with just 3 of us in it. We didn't raise outside capital at that point. We funded it ourselves. But again, as we grew and got a new client, we would simply bring in another consultant. And so we were able to keep the flow of the dollars coming in, kind of matching the flow of the dollars going out. But we weren't growing quickly. We were sort of enjoying the lifestyle side of what we were doing. So, you know, here again on that first slide, I probably wouldn't have answered that our goal was to grow Insomnia that fast. We didn't want to become the largest consulting firm on the planet and take on McKinsey or Accenture or anything like that. And so that business had very different decisions in terms of where we got our capital. And we kept it all in-house, and we didn't do debt, and we didn't do, you know, any large equity raises. So that was sort of the extreme opposite of what I had experienced before then, which was all venture funded. From there, I ended up starting the first product company that I had ever started, where I actually had hard assets like molds and inventory and, you know, distribution centers and third-party partners. And that was really a completely different challenge because we started funding it like we had Insomnia with our own personal capital, but quickly realized that as we were growing and selling into, you know, places like airport convenience stores and Whole Foods and Kroger, that our problem was we were growing to death. We didn't have enough capital. And so as you can see, I've lived on every side of the coin, and, you know, perhaps you could argue each time I started out doing it wrong and then figured out what the right solution was. But with Nourish, we couldn't find a solution because unlike Insomnia, we did need to bring third-party capital in because we needed to build inventory and buy molds and get that product ready to ship to these large customers. But unlike Dunk and IXL, as we talked to some of the private equity groups that wanted to invest, we didn't really want to give up half of our company off the bat because we had, you know, spent so much time building it. And so we were faced with this scary reality that the very thing we had worked so hard for, which was these big orders, was exactly what was going to put us out of business. And this is actually where I met John Hayes, who's also on the call and is going to walk us sort of through his background and some of the things that he's developed. But I was fortunate enough to meet John because I became his customer. You know, he had founded a really interesting company and program in partnership with Synovus Bank here in the Southeast, and they became a valuable partner of Nourish as we were growing. But what it enabled John and I to do was to look at a problem that we had both experienced for years from a totally different lens. And it's because of that John and I are both sitting here today and started Now Account. And what we realized is I always laugh when people throw around the term cash flow because most people think the most important part of that word is the word cash. And I came to realize that perhaps the most important part of that word is the word flow, because my cash in someone else's bank account is really not very useful to me. And so it was because of that realization that John and I started Now Account. And what I wanted to do is tell you a little bit about what we're doing at Now Account because it'll give you a little bit of background. And then I'm going to have John kind of walk through this innovative model of how we think about high-growth companies and small businesses and mid-sized businesses and how they can look at optimizing their capital. So the realization that I had with Nourish, which many of you, if you are starting or running small and mid-sized businesses, will experience, is that as I was selling into these larger and larger companies, they took forever to pay. And that was confusing to me because when I had started the business selling to smaller businesses, they would just pay me with a credit card. And so John and I started to look at the credit card as a model, and what we discovered is that the credit card works exceptionally well when you go to Starbucks, or it works exceptionally well when you go to Nordstrom to buy a shirt. And the reason it works so well is that that retailer that is selling you the good is going to take your credit card for payment. They're going to get paid that day because they're going to settle that with their merchant service provider. And then when and if you pay your American Express bill is not their problem, right? You're going to pay it 20 or 30 days later, and if you don't pay it, it doesn't come back to bite the merchant. And so everyone is happy. It works well for both sides. But what I realized with Nourish and with Insomnia is that when you're a business selling to other businesses or governments, you can beg all you want, but they are not going to pay you with a credit card. And the reason they're not going to pay you with a credit card is they actually like to get your invoice. And the reason for that is that it's free. So if you think about it, when you're the small business selling your good or service to someone else, and they ask you to send them an invoice that says net 15 or net 30 or heaven forbid net 60, net 90, what you're essentially telling them is I'm going to send you the product or deliver the service and you can pay me later. The problem is you have to come out of pocket to buy the materials, to make the product, to hire this staff, to deliver the service. You have to do all of that out of your own pocket, and then they're going to pay you later. And unfortunately, what I came to realize is they're not even going to pay you when the invoice says. Because my invoices used to say net 30, and I can tell you for certain that I don't think I ever got a check within 30 days. It was usually 50 days, 55 days, 75 days, and that was only after I called them several times to point out the fact that they had not paid me. And the reason, again, for that is that they're using your capital to fund their business. And so essentially what we created was a connection of the green dots where if you're a small business selling to other businesses and governments, you can use your Now account, get paid immediately in a way that feels like taking a credit card. It's not a loan, so there's no debt on your balance sheet. It's literally just revenue acceleration, meaning you're getting your revenue that day or in 2 days or 3 days. So you're getting your revenue right away as opposed to borrowing and then waiting for your revenue to come later. And at the same time that you're doing that, your customer still gets their invoice. They still pay when they feel like it. They even make the check out to you, but it goes to a lockbox that we control because we've already paid you. And so it's a way for the small business to get paid immediately with no liability, no debt, and their customer to still get that free accounts payable that they've come to enjoy. And so what we find now that is so exciting to me is every day we're working with small businesses that are not in trouble, but they have all this opportunity to grow. They could grow into new businesses, they could take on new customers, they could sell more to those existing customers, but their shoes are tied. They can't move too fast because they don't have their capital. And we jokingly say until now, because now we found a way to get that capital in their hands. And so I want John to kind of take a few minutes and tell you a little bit about his background, but really what we're going to talk about next is using the right capital at the right time for the right use. What is the right capital, right? I mean, I know what you're thinking is get to the dang punchline. so here we are. So John, if you want to, tell a little bit about your background, and then we'll kind of go into this model you've developed and the continuum of capital.
Laura, thanks. Sitting here listening to you, I was thinking back what sort of relevant points might be worth mentioning, and it actually starts, I guess, when I was a student at Tech. I was a co-op student for Martin Marietta, which is now part of Lockheed, and I started out as a mechanical engineering student, and in my second quarter at Martin, I was put into an operations research group which was looking at building a simulation of a ballistic missile attack on the U.S. by both China and Russia at the same time. Bad news is, there's not much you can do about it. But the exciting part about that is I was with some really smart operations research people, systems engineers, and Tech had just changed the industrial engineering school to be the School of Industrial and Systems Engineering to focus on the whole new discipline of OR and these related fields. So when at the end of that quarter, I switched from ME to Industrial and Systems Engineering to focus on being able to look at things kind of from a systems view. And as you were retelling the Now Account story, I was thinking that's exactly what we did 5 years ago when we sat down, you and I and Stacey Abrams, on a large table with some big white sheets of paper and diagrammed out how the credit card system works, how asset-based lending works, how all these other mechanisms in the economy work to get capital into the hands of small businesses. And like all good engineers, we took it apart, we thought about how you dissect all these systems, and we reassembled it, and we did end up with some extra parts over on the side that we've never used. But I guess thinking about it, in my experience, that the operations research work at Martin Company gave me the opportunity of trying to think about things in a little bit larger context, and that's sort of what we've done in putting together this chart of talking about what the way capital works. And what Laura's got on the screen right now is a set of income statements, the income statement at the top and the balance sheet in the middle of a typical business. And it's a flow chart.
Clearly an engineer's balance sheet.
Yeah,
it's not a list of numbers.
Well, I will tell you, the two of the hardest quarters I ever had at Tech were taking accounting. Back when I went through Tech, we were on the quarter system, and IEs took 2 quarters of accounting, and it was a struggle. I was halfway through the first quarter before I figured out what in the heck a debit and a credit were. And the truth of the matter is that for 500 years, we have organized financial statements into columns of numbers against text, and that doesn't really give you a good feel of how things flow and how money flows and how cash flows. And that's what this symbolic accounting representation that you see on the screen does, is it starts out at the top with the income statement starting with revenue and flowing through cost of goods sold, operating expenses, interest and taxes. It doesn't have non-cash items of depreciation and amortization because it's talking about cash, and that flows back into earnings. But in reality, the way most businesses think about where's my cash, they don't think about it coming in, kind of at the end of the year in earnings. They think about what comes in every day by what I'm getting paid. And that's what you see, the dotted lines coming off of revenue and going directly into cash, whether it's a cash itself, you get paid with a check or some other cash equivalent, or you use a revenue accelerator like taking a credit card for payment or using the Now Account, and that goes to cash. If you get paid in an accounting sense, you recognize your revenue, but it just goes to accounts receivable. That's a nice paper entry, but it's darn hard to make payroll with accounts receivable. So the funny thing about it is that when this whole notion of representing financial statements in a symbolic way is something I started using about 10 years ago, and you actually know because I came to one of your classes that you were teaching.
At the Scheller College, the finance class that I was teaching, John came and used this to teach the students how to think about financial statements.
And we actually did a little market research because we gave them, half of them, a set of financial statements in the traditional way and the other half financial statements in this way, and asked them a series of questions, and then we switched and did it again, and not surprisingly, people were able to answer the simple questions about what's the most important source of capital, what's your biggest use of capital, et cetera, much we went ahead and filed a patent application on it and had the patent granted. I don't know what good it does us, but we're sitting there as the owner of the patent on this symbolic accounting stuff. But I want to make one quick observation about it before we talk about the actual way we've gone about classifying sources of capital. And that is, on the left-hand side, you see the arrows flowing in, which are accounts payable, debt, other liabilities, invested equity, and earnings. Those show up on the balance sheet as liabilities and equity. And the only real difference between a liability and an equity is a liability is something you owe someone else, equity is something you owe the owners. The right-hand side are the assets, the use of capital, inventory, accounts receivable, property, plant, and equipment, and other assets. And then cash, and cash is an asset, cash is a use of capital because it is sort of the repository. But everything else that's an asset is money that's actually flowing out of the business. And the funny thing about this is that the terms we use for this liability and assets are the opposite in their common vernacular.
You think of assets as good and liabilities as bad.
Right.
But liabilities are your source of capital.
And if I said Chuck over here is a real liability for this company, that sounds really negative. If I said to you, Chuck over here is a real source of capital for this business, that sounds pretty positive. But, and the point I'm making is that when you see it graphically, when you see sources of capital flowing in and uses of capital flowing out, it puts it in a little bit better context because I think people frequently have an emotional reaction to looking at the asset side of the balance sheet as being better, but it not necessarily is. It's where your money has gone. In trying to think through how do you try to make sense of all of these new ways of getting capital that have come into the marketplace in recent years, it's really interesting. There was a great article in Wired in the past few days about Wall Street's reaction to Silicon Valley. And it's not just Silicon Valley because not all of fintech is happening in California. Certainly Atlanta is the home of a tremendous amount of fintech activity. But what you've got coming into the marketplace are a lot of new entrants who are bringing sources of capital to businesses in a much more streamlined, easy-to-access way. These different providers have got many different names. People were calling it P2P for some reason, which that doesn't make any sense. They're not peer-to-peer lending. I mean, they're aggregating money.
Lending platforms.
Really, yeah.
Internet lending club.
Yeah, our good friend Richard Fram has labeled them internet lending platforms, which I think is a very good label. And what they really are is unregulated lenders. They're like On Deck and Lending Club, and some of these other folks are aggregating capital together. Fundbox, Bluevine, yeah, a ton of them out there. And they're filling a niche because two things have happened. One is the banks have gotten bigger and bigger and have tended to move away from focusing on small businesses. And when they do focus on small business, they tend to focus on real estate lending, which frankly is not the largest asset of most businesses. Most small businesses that sell to other businesses have more accounts receivable than any other asset and have inventory perhaps, but property, plant, and equipment, the real estate that a bank likes to lend on is just a small part of the
Well, that's why in your chart the accounts receivable arrow is bigger, right? That's the largest asset that most businesses have.
Exactly right. And just as you pointed out a minute ago, the reason that is that the customer wants it that way. They want that free money because on the left-hand side, accounts payable is shown as a large input on this diagram. That's assuming you can get your vendors, the people that are selling you goods or providing you services to give you credit and not force you to pay them for 30 or 60 days. But if you're selling to, as you well know, if you're selling to any large company, you're going to have to give them terms, and that's a huge use of cash, and the banks don't like to lend on that. They have really moved away from it in the last 30 years or so. But what a lot of these new entrants have been able to do is come in an unregulated environment and offer products in a much easier to access, more streamlined fashion. So have you got the other chart? Yeah. What this chart up on the screen shows is a way that we have gone through in a typical engineering fashion and tried to classify all the different sources of capital, major sources of capital that are out there in the market for a small business. And the two big ones in the middle, debt and equity, are what everybody typically thinks about as sources of capital. But in reality, sales and revenue is an extremely important part of your source of capital because it's immediate. That's what flows into the business immediately. Now, from a pure accounting standpoint, that cash becomes available to the company down at the very bottom in the equity section as retained earnings eventually. But you really need to think about this, I think, broader than just the technical accounting definitions of sources of capital, because what a small business experiences on a day-to-day basis, or even a medium or larger business experiences on a day-to-day business, is what cash is actually flowing in the door. I've also included down at the bottom grants to for-profit businesses as a source of capital. Even though it's relatively small compared to the others, I've included it for an important reason. One, it's available, particularly if you're a engineering-oriented kind of firm and you've got an R&D component to what you're doing. Georgia Tech has a very active program to help link entrepreneurs up to the SDIR and the STTR programs. But the other reason I've included it on this chart is that there are 3 times as many grants given every year to for-profit businesses. And these are not loans. These are actual outright grants by federal or state agencies or other entities to small businesses to try to spur innovation. There are 3 times as many of those grants given as there are new firms that get venture capital investments every year. And the reason I make that contrast is somehow in our economy, the idea of venture capital has become a really important front-of-mind kind of experience.
Well, business schools have entire courses on venture capital.
Right.
And it's interesting because as a percentage, it's less than 0.5% of businesses will ever touch it. Yet we dedicate huge amounts of focus on venture capital, which is really, if you lined these up in terms of the number of businesses that will ever benefit from them, wouldn't even show up. It'd be so small.
And, and I've been very active in the ATDC at Georgia Tech for 30 years now, and there's a big emphasis at ATDC in trying to get companies ready for going after venture capital as if that's sort of an important milestone, when the reality is, as you pointed out, it may or may not be the right dollar at a particular time, because there's a lot of overhead that comes with any kind of equity, whether it's
first of all, you give up your company.
Right, exactly right. You give up control. There is no doubt about it. You give up a large measure of control anytime you take venture capital or institutional private equity. Even taking friends and family. I mean, going to a holiday party when your business isn't doing so well and half the people in the room have funded it. It's an embarrassing proposition. So there's some cost to all forms of capital that come in, and there's different cost and different burden, if you will, to any of it, whether it's debt or equity.
Well, and really, as you go down this chart, cost goes up and risk goes up, right? So if you start with cash and cash equivalents and revenue accelerators like credit cards and Now Account, that's your lowest cost, lowest risk source of capital. And as John always points out, there's still risk there. I mean, the cash could be counterfeit. So there's some risk, but it's very, very minimal. And because of the timing of getting it right away, it's your lowest cost capital. And then as you start to get into debt, you've got a range of risk and cost, based on loans that are unsecured or they're secured by assets in the business as opposed to loans that are requiring personal guarantees. And, it's interesting because more and more, there was a time, I know most young alumni wouldn't know this, but there was a time when you could get a loan without a personal guarantee. And these days, every time I sit on an access to capital panel with SBA lenders or bank lenders or CDFIs or micro lenders, they will all say you're going to have to put up personal guarantees, which I still think is kind of funny because that makes it a personal loan to your business. But for a number of reasons, like in my case, when I started my business, I was a new mom, and the last thing I wanted to do was put my personal assets at risk, my home and my family, and so personal guarantees were not an option for me at that point in time. So that could have kept the business from growing if I hadn't, found some other sources of capital. And then, of course, when you get down to equity, that's the most expensive capital that you can use.
Yeah, absolutely. We've had a lot of fun putting this chart together, and we have shared it and gotten some really good feedback from some of our investors and other folks that are knowledgeable about it. And we're going to continue to work on this, and we'll have it out there at some point on the web where people can look at it, and we'll do some narrative behind it too, so that we can go in and talk about what each one of these things mean. And like in the cash flow lending, what's a merchant cash advance? What are the other kinds of cash flow lending? And then also spend a little bit more time in this talking about the on the equity side. There's some really interesting things that have happened there, including this, and I'll just mention it. The Congress has made it much easier for smaller businesses to sell stock to a larger number of people and not have that stock be restricted with something that's now called Regulation A+. So there are some really interesting things happening on all different aspects of this continuum on sources of capital for small businesses. But I think the important part about this is that it really emphasizes what you said earlier, and that is that it's not all dollars are equal.
Right.
I mean, a dollar coming in to a business in the form of currency or a check or taking it on a revenue accelerator, whether it's a merchant service or a now account, is a very different dollar than if you had to go out and borrow that dollar from the bank and you've got a fixed payment obligation on it, or you took that dollar from an investor and you've given up part of your company in return for that. So
right.
I think you're absolutely right. One is not equal to one.
Wait. And it's interesting because Harvard Business School has done a case on this topic. They started out doing a case on Now Account, but they've now done sort of a case note on non-equity funding of high-growth companies. And a couple of really interesting things came out because we had always talked about using the right capital for the right use. And examples of that I've seen over the years are, someone might have a line of credit, and then they'll draw on that line and go buy equipment. That's a really bad thing to do because the line of credit is a short-term variable form of capital that's meant to be drawn on, paid back, drawn on, paid back, drawn on, paid back. And the minute you take those dollars and you go buy a fixed piece of equipment that's not going to generate the capital to pay that line back quickly, you've now mixed up the wrong capital for the wrong use. So if you're going to buy equipment, you should be looking at term loans and things like that where the life of the financial asset matches the life of the physical asset that it's funding. And so, likewise, I'll see people go out and raise private equity or venture capital or angel funding knowing that there's a long time horizon. And anyone who's ever had, a venture capitalist or an institutional private equity group knows that they have a very fixed horizon, and they expect to see a return in some period of time, usually, 5 years, 3 years. So if your company is not expected to generate that return until year 10, I can already tell you that year 3, 4, and 5 are going to look ugly for you. And as John mentioned, not only will you not be able to go to holiday parties, but you'll be arguing with your investors. And so knowing that going in, if you're still there, you know, I have turned down venture investors and flat out said to them, we're going to be fighting in year 3. I know that. So why would we even go into this together? But I think when we were doing the case with Harvard, what became even more obvious to me was not only is it the right dollar for the right use, but there's also the right time. And I was on a panel last week where one of the private equity guys flat out made the statement, if you're an early stage company, you should not have debt. And I thought that was an interesting statement because I thought, well, I mean, you never know. If you need to buy real estate, you need to buy equipment, then debt's probably the right way to fund that. But the point he was making is that in your earlier stages, your business is more sporadic. It's less forecastable. It's less controlled. And so when you put in place a debt instrument that has fixed payment dates, chances of you having your cash inflow match that date are pretty low. And so you're always going to be off by a few days. And I remember a student at Harvard making the comment that what they liked about Now Account and the revenue acceleration was that you never owed money without money coming in. And so never were you in a situation to miss a payment. And so I think, again, that sort of highlighted the timing piece for me to make sure that you're not taking in short-term capital to invest in the long-term asset or taking in long-term capital and expecting to show a short-term return, because it's just simply not going to happen. So I'm just looking at, I think my 44-year-old eyes can't see the clock very well, but we're coming up on 10 till. So I just wanted to, you know, kind of finish out this last slide, and then we can open it up for questions. Anyone who's been on the calls previously know I always end with all the mistakes I've made. I had someone the other day say, do you have any words of wisdom? And I said, well, not really. I just have lots of mistakes, which is probably the source of wisdom. But you know, if I had to think back to the businesses I've been involved with, whether it's the consulting company or the footwear manufacturing company or the water manufacturing company, the one thing I realized is terms will grow you to death. And, you know, John said it, it's the cost of doing business. Is if you're going to grow your business, you have to sell to larger customers. And if you're going to get the larger accounts, they're not going to pay you with cash up front. They're going to make you give them terms. And so you really have to think through before you take that order how you're going to fund those terms. You know, in most cases, hopefully a revenue accelerator works for you, whether it's taking a credit card for payment or using a Now Account. But if it doesn't, you really have to think about that. My mistake as an entrepreneur was take the order and figure it out later. And you do not want to be in a position to figure it out later because your options get drastically reduced. The next thing I realized is that there is actually such a thing as a business credit score, which I never knew existed. You know, I knew I had personal credit scores, but your business has a credit score, and it's not your FICO score, and it has nothing to do with your personal credit. If you didn't know you had one, you should find out. Equifax has a commercial website that you can go to and, you know, figure out what your business credit score is. But make sure you have one, and make sure that you maintain it and monitor it just like you do your personal credit, because it's the key in many cases to your business accessing capital. We've said it 50 times on the call so far. Get it right. Use the right dollar at the right time for the right use, and make sure that you align your cash inflow with the timing of the payments, because it doesn't matter how profitable your business is. If you don't have the cash, you won't live to see the profit. And so with that, I think that's the last slide I had. Caroline, if you want to open it up to questions, we can do that.
That sounds great. Thank you, and Lara and John, so much for leading us today. Very interesting. And yes, it turns out capital is a hot topic. I've had several questions peppered in throughout the extent of the call. So let me start out with our first one. How does Now Account facilitate transactions? Is it purely digital financial transaction, direct deposit into a bank account? How does that work?
So there's two sides to the transaction. When the small business sells their good or service to their customer, they log into Now Account through a web interface, and they give us a copy of the invoice, which of course, can be faxed or scanned. That can be sent over digitally. And then we pay all of the small businesses immediately through ACH. So that is an electronic transfer of capital. Their customer, however, that then gets their invoice and pays at some point in the future that's undetermined, they can pay in any form they like. So most of the payments that we get in come in the form of a paper check still. But they can also pay by ACH or wire. So our money going out is all electronic, but the money that we take in is whatever form that customer typically paid, usually by paper check.
Got it. Okay, another question actually involving Now Account. What are the associated costs? How does that work for one of your customers?
So if you have a Now Account and you are sending out an invoice that has up to net 30 terms, then it's a flat 2.5% fee. It doesn't matter when or if the customer pays. That's our risk. If you offer extended terms like net 60, it's a 2.75% fee, and if you offer net 90, it's 3%. So the fee is a flat fee based on the terms that you extended to your customer. The only time that changes is if your customer's outside the United States, if it's actually an export, then there's a 1% surcharge, so it would be 3.5% for a net 30. We actually have one client that is a Georgia Tech alum that has a chemicals business, and they primarily use their Now Account for those export opportunities because they had big opportunities to grow by selling abroad, but they didn't want to take on the risk of when or if they got paid. And so Now Account removes that risk for them.
Got it. Great. Okay, another question is involving risk. Let me scroll down to that one.
We don't like it.
So how do you manage your risk? Is it the credit history of your clients? Do you use accounts receivable as collateral? Can you talk about that a little bit?
You want me to respond? There are two parts to the risk here. One is the part that the buyer, the customer, doesn't pay the invoice that they should pay.
Right.
The other risk is actually on our client, the seller, that they can't honor a dispute. In other words, if they ship broken widgets, they obviously need to make whole on that. And if they get in financial trouble and can't, or they just commit fraud. And we manage it to a very
well-engineered,
extremely well-engineered risk management system that we've also filed a patent on, by the way. And that really is the key to how Now Account can offer the service we do at such a very reasonable cost to the small business, is that there's a very well-engineered risk management system behind it.
But how we assess that risk is very invisible, and it's rules-based. So we're not collecting personal information. We're not looking at personal credit. We're not collecting financials. We have a series of kind of rules-based decisions that we can make based on data that we can get without interfering with that customer and client relationship. So we can assess the risk very quickly, and then our structure, as John mentioned, helps us mitigate and manage what risk does get through those filters.
Got it.
It's kind of like our holistic attack model of Martin Company a long time ago, except ours actually works.
I was going to say, wait a minute, at Martin you decided there was nothing you could do about it, so I don't know.
That was 45 years ago. We figured it out since.
And one additional thing. So regarding the liability and your liability specifically, if a client does not pay an invoice, do you all sort of intervene in the process, and do you take on that, trying to get that money from the outside?
Yeah, we take that risk, and when we buy that invoice, we manage that AR. So our client has sent an invoice to their customer. They've gotten paid. They're off growing their business. We send monthly statements out of our office to all of our client customers. But the statement doesn't say Now Account. The statement has our client's name at the top, and it shows what AR is outstanding outstanding, 0 to 30, 31 to 60, and so forth. And so we'll send those statements out for a few months until that invoice gets 90 days past due. And then we actually turn that over to someone else to manage. We don't do what you would call hard collections in our office. And what we find is most of the time the invoice gets paid. It's paid exceptionally late, but it will get paid within that 120-day period.
Yeah, it's something on the order of 99.8% of the dollars of business-to-business invoices that are legitimate invoices are going to get paid. And compared to consumer, in which you've got consumer cards or consumer credit has a much, much higher default rate. The default rate on B2B transactions is actually relatively low.
It's just a small business can't live long enough to see that.
To see that through. I see what you're saying. Yes. Well, that takes care of all the questions. I think we're very nicely timed today, and I appreciate it again, Lara and John, so much for you all and adding your insights, and this was fantastic, and I look forward to seeing you all and as well as our guests online next month, and we'll be getting information out to you all shortly.
Great. Thanks, Caroline.
Thanks. Have a great afternoon.
Bye.
Bye-bye.